ETFs are not an asset class. Most people think they are, and that confusion causes more investing mistakes than almost anything else. So, let's slow this down. The previous videos covered what a stock is and what a bond is, in depth. Here, we will use those ideas as building blocks. I am going to do 3 things. First, a short recap of what a stock is. Then, a short recap of what a bond is. And only then do we explain what an ETF is and what it is not. Because once you see the difference, a lot of modern investing confusion disappears. A stock represents ownership of a business. That ownership comes with a few important characteristics. First, participation in upside or stock appreciation. If the business grows, the value of that ownership can grow. Second, residual claims. If a company goes bankrupt, shareholders are last in line, but they still do have a claim. And third, there is no guarantee of return. Stocks grow with businesses, but they also fall sharply. The risks in stocks doesn't come from volatility itself. It comes from uncertainty of outcomes. Will the company execute well? Will the sector remain competitive? What about demand? Will it exist in 10 years? Those unknowns are the price of ownership. Stocks are about growth and variability, not about safety. Now, let's contrast that with bonds. A bond is not ownership. A bond is a loan. And when you buy a bond, you are lending money in exchange for a promise. And that promise has 3 parts. Fixed payments, which is the return of principal or borrowed amount, and a defined time horizon, which is the bond's maturity or length of the loan. Unlike stocks, bonds don't give you upside if things go well. You don't participate in growth. Instead, you trade that upside for predictability. But that does not mean that bonds are risk-free. Their risk comes from different places, such as time, inflation, interest rates, or creditworthiness. Even when payments are promised, their real value can change. So, bonds are about time and cash flow, not about safety. Now, we can finally talk about exchange-traded funds. An ETF is not a new asset class. It is a container. When you buy an ETF, you are buying shares of a fund, and that fund holds other assets. An ETF can hold stocks, it can hold bonds, it can hold commodities. It can hold dozens of countries, a single sector, or a specific rule-based strategy. And for example, buying a stock is like buying a single apple. Buying a bond is like lending the farmer money in order to buy a new tractor. The ETF is the pre-packaged fruit basket. What an ETF changes is access, convenience, and liquidity. And by access, I refer to the fact that you can buy 500 companies with $100. And by liquidity, that you can sell it as easily as a single stock. An ETF does not change the DNA of the investment. 1,000 risky stocks inside a shiny ETF wrapper are still 1,000 risky stocks. An ETF does not make assets safer, and it does not make them riskier. The risk, it comes from the contents, not the wrapper. Modern platforms and communities all emphasize labels, not exposure. ETF feels much simpler than asking what is actually inside. Diversification often gets mistaken for low risk. But bond ETFs feel like bonds until interest rates move. This isn't stupidity, it's structural misunderstanding. And here is an example. Think of a bond ETF that is high yield. Let's say 10%. The label says bond, which sounds safe. But high yield is just a polite way of saying risky loans. If you buy it thinking it is as safe as a government bond, just because it is a bond ETF, you are looking at the wrapper. You're not looking at the contents of the wrapper. The wrapper is visible, the underlying risk is not. So let's be very clear about where returns come from. Stocks generate returns through business growth, earnings, and reinvestment. Bonds generate returns through interest payments and repayment of principal. ETFs, on the other hand, generate returns only through the assets that they hold. No wrapper creates return on its own. A portfolio is not a collection of products. It is a combination of exposures. Ownership risk, time-based promises. ETFs are often the delivery mechanism, not the decision itself. Good portfolios are built around goals, time horizons, and tolerance for uncertainty, not labels. Stocks and bonds are tools with very different behaviors. ETFs are a way to access those tools efficiently. Confusion starts when labels replace understanding. And tools serve goals. Goals should never serve tools.